In January 2026, the most valuable private company on Earth quietly began showing ads. For most startups, that's just Tuesday. For OpenAI, a company built on the promise of transforming civilization, whose CEO once described advertising as a last resort, it was something closer to a confession. Sam Altman made that last resort comment in October 2024. 14 months later, banner ads were appearing in ChatGPT's free tier alongside a new $8 a month subscription option. You don't need to read between the lines. The lines say it plainly enough. The story of how OpenAI arrived here is, at its core, a story about a bet that stopped paying off and a company that kept raising the stakes anyway. To understand the bet, you need to go back to 2020, when a team of researchers at OpenAI published what felt like a discovery of a natural law. Led by Jared Kaplan, who later followed Dario Amodei to found Anthropic, the paper showed something that defied decades of conventional wisdom in machine learning. Bigger models, trained on more data, with more compute, didn't just improve, they improved predictably, along a smooth mathematical curve. This was the scaling law, and it turned Silicon Valley into a gold rush. If the curve held, each new model would make the last one look primitive by comparison. AGI, maybe, was just a few doublings away. The curve held, until it didn't. By the summer of 2024, OpenAI had trained its next major model, internally called Orion, on a data center built specifically for the task. Altman had reportedly told staff it would blow everything that came before it out of the water. When training finished, performance gains over GPT-4 were marginal. The scaling law, the foundational premise on which hundreds of billions in investment had been justified, had broken. Or, more precisely, it had plateaued, somewhere around the capability level of GPT-4. And no one inside the industry had a consensus explanation for why or what came next. This matters enormously because the scaling law wasn't just a research finding. It was OpenAI's entire business model. The logic ran, spend aggressively now because each dollar of compute translates into capability improvements that translate into market dominance that eventually translates into profit. Pull out any link in that chain and the whole structure becomes something else entirely. A company burning money faster than almost any in history, with a less certain destination than its fundraising decks imply. Internal projections show $14 billion in losses for 2026 alone. Total losses from 2023 through 2028 are expected to reach $44 billion, before the company projects turning profitable in 2029. For context, the Manhattan Project, adjusted for inflation, cost roughly $30 billion. OpenAI is proposing to lose more than that in 5 years, building something it isn't yet sure how to monetize at scale. The company has signed up to $1.4 trillion in infrastructure commitments over the next 8 years, an obligation roughly 70 times its current annual revenue. Against that backdrop, the Oracle contract stands out, even in a document full of alarming figures. OpenAI reportedly generates around $13 billion in revenue annually from ChatGPT and API access fees. The infrastructure bill is, by any normal business logic, catastrophically disproportionate. The company's response to all of this has been what you might charitably call optimism. Internal forecasts project revenue reaching $100 billion by 2029, close to what NVIDIA currently makes, driven by explosive adoption of AI agents and enterprise services. It's possible. It's also the kind of projection that requires virtually everything to go right in a competitive landscape where virtually everything is going wrong. Because the scaling problem isn't only OpenAI's problem, but OpenAI's competitors are handling it better. ChatGPT's web traffic share fell from 86.7% in January 2025 to 64.5% in January 2026, while Google Gemini grew from 5.7% to 21.5% over the same period. Apple's decision to integrate Gemini into Apple Intelligence rather than deepen its existing OpenAI partnership, was the most visible signal of a shifting landscape. The everyday mobile use case, snapping a photo, asking your phone what you're looking at, getting directions through a camera, turns out to favor Gemini's multimodal and real-time information strengths over ChatGPT's writing and conversational ones. Google, nearly caught flat-footed when ChatGPT launched in late 2022, has more than recovered, and it has something OpenAI fundamentally cannot replicate. Google made $86 billion in revenue over just 9 months in 2025, which means it can fund AI research indefinitely without ever touching a venture capitalist. Meanwhile, the open-source threat emerging from China changes the competitive calculus in ways that are harder to quantify, but potentially more disruptive. DeepSeek's R1 model, released in early 2025, demonstrated capabilities approaching frontier models at a fraction of the training cost, and then published its methods. Chinese models like Qwen are gaining traction globally. If capable AI becomes a commodity, the entire strategic rationale for pouring capital into a single proprietary lab collapses. Anthropic, for its part, projects dropping its cash burn rate to roughly 1/3 of revenue in 2026 and down to 9% by 2027. A starkly different trajectory that suggests the winner of the AI race may not be whoever spends the most. The talent picture compounds everything. Engineers at OpenAI are reportedly 8 times more likely to leave for Anthropic than the reverse. CTO Mira Murati and co-founder Ilya Sutskever are among a wave of senior departures, including research leads and alignment researchers. OpenAI is, in effect, training its own competition. The company expected to spend $6 billion on stock-based compensation in 2025 alone, nearly half of projected revenue, in an attempt to slow the outflow. That is an extraordinary number, and it points to something more than a compensation problem. When a company's most talented people are leaving at that rate to build rivals, it suggests a confidence issue that equity packages can't fully resolve. Then there's the question of Sam Altman himself, which the financial picture makes impossible to avoid. His career is a series of swings between genuine vision and overreach, a ratio that investors have historically been willing to forgive in Silicon Valley, provided the vision eventually lands. The more pressing issue now is credibility. Altman's signature move has been to promise transformative outcomes: curing cancer, replacing your doctor, automating the entire economy, on a timeline that consistently fails to materialize. That works when the scaling law is providing steady proof of forward progress. It works less well when the progress has stalled and the losses are accelerating. In 2015, OpenAI launched as a nonprofit with a mission to develop AI for the benefit of humanity. It had no revenue, no plans for revenue, and no particular model for how it would ever make money. In 2026, it is a company with a $300 billion valuation, $1.4 trillion in infrastructure commitments, a circularly dependent relationship with its investors, and a CFO who has to clarify whether the $20 billion revenue headline refers to actual 2025 earnings or a single month's income extrapolated across a year. The distance between those two versions of OpenAI is not just financial. It is a story about what happens when a company built around an idea that intelligence can be scaled like a product runs into the hard edges of that idea. The ads in ChatGPT might work. The $100 billion revenue by 2029 might materialize. The scaling problem might get solved by some breakthrough in architecture or training technique that nobody has published yet. All of these things are possible, but the question that hangs over every projection and every fundraising round is a simpler one. In a world where capable AI is becoming cheaper, more distributed, and less dependent on any single lab's infrastructure bet, what exactly is OpenAI selling that justifies its cost? Make sure to like and subscribe for more content like this.